All right, it's that time. Welcome to Degrees of Freedom, where I go over 5 slides in 15 minutes about the note industry so you can be enlightened about your own degrees of freedom. Hello, my name is Dr. Engerman, and I will be your helpful host today. If that's a topic you'd like to learn more about, hit that like button, hit the notification bell, and subscribe to this incredible channel. Today, we've got a juicy one for you. We are going to be talking about the note industry and inflation. Everything is up. Gas is up. Groceries are up. Carrots are up. Milk is up. What is going on? And more importantly, what does it have to do with the note industry? What's the relationship? That's what we're going to talk about today. Look, we're going to talk about what inflation is. We're going to talk about the historical real estate in inflationary times. We're going to talk about international outlooks on inflation. We're going to give some examples, and then finally your golden nugget for today is going to be the 5th slide, options in note investment. So let's get into it. Notes and inflation. Let's get busy. First and foremost, the information presented on Engerman Estates channel is for educational use and purposes only. I am not a licensed financial institution. We are not a licensed financial institution, an investment advisor, financial strategist, lawyer, or CPA. Engerman Estates is not liable for any losses resulting from any action taken by a viewer based on the information presented or shared on this channel. Engerman Estates cannot promise earnings or returns based on historical reports or achieved by a party or affiliate in connection with the information presented. Look, the first place we start is about inflation. What is it? And I'm going to start on the right here. I know usually you read left to right, but the right side is really important. We've got to understand that in the U.S., as of February 2022, that just happened, inflation was sitting at 7.9%. And in fact, I believe it's up to 8.5% at this present moment. We're talking about the month of April. So we are looking at this line and we are seeing what's going to happen next. I don't know about you, but that's looking like a straight line. Straight on up. Straight on up. All right. Obviously, we can see with the graphs, and I'm going to show you some more graphs, that inflation is on a rampage. But what is inflation? For that, we look to the graph on the left. And quite literally, what inflation is obviously the rising prices. The cost for goods and services, they rise. But it really is an attack on the purchasing power of your money and the dollars. Put blankly and simply, that's what it is. And check this out. Back before 1920, the dollar meant a dollar, roughly, when it was generated, actually. So the Federal Reserve Act creates a central bank with the ability to manage the country's money supply, right? The supply of money. Immediately, that had a sharp fall down into the 20s. But right here is where things get interesting, right? What happens here is we have a Great Depression, obviously, right? And what happens is President Roosevelt, he criminalizes the possession of gold. What does that mean? You can't have gold. You can't own gold as an individual. Bad business. But behind the scenes, what really happened is we were stacking it up like crazy. All right. Over here, the Bretton Woods Agreement established the gold standard, and then all of a sudden, the U.S. dollars became the world currency, right? Well, really, these are treaties, right? This happened after World Wars. So it still continued to drop, and this is the purchasing power over time until we get to the 70s, and Nixon started to say, hey, look, we're getting off this gold standard. This stuff is no longer what we want to peg our dollar to, and we're off the gold standard. And really what happened is you couldn't extract it out of the banks because they were losing it left and right. So they kept all the gold. They didn't allow you to take it out of the banks. And the dollar continued to fall in its purchasing power. Okay, we have QE happening here, which is quantitative easing. Back in 2008 was the more recent of the most recents. 2008, what happened obviously in 2020 and 2021, and now we have the QE that was the most recent. But that is money printing. Okay, and as that happens, the dollar purchasing power continues to drop. Drop, 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 drop. And obviously, the inflation continues to rise. And so that is generally what inflation is. It is a problem, and it has to do with your purchasing power, how well your money kind of travels. And to highlight this even further, we got to go a little deeper and connect it to the real estate market. So top left, we start with Bloomberg. And Bloomberg wrote this incredible article back in January here, talking about the real estate is emerging as a hedge against roaring inflation. No duh. Those seeking alternative investments from stocks and bonds, which is paper, may turn to the housing market, but their strategy still presents risk. Okay, but obviously they're worried about, in this article, they are worried about the real estate market falling, right? But nonetheless, a hard asset is still seen as a hedge against inflation here. To go further, Fox Business says mortgage rates increase as rising inflation causes concerns among investors. Dun, 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 dun. So what do you think is happening here? Check this out. Historical real estate in inflationary times. Historically, we go backwards and we see on this incredible site, which is 2013 dollars, called the 2013dollars.com. I should say .com. This is what happens. A $20,000 house in 67 is now, it costs $189,000 in 2022. This is a really great calculator. You can put any price that you want in here, and it will break out the value of that those dollars from 67 to present time. So according to the U.S. Bureau of Labor Statistics, prices for housing are 847.62% higher in 2022 versus 67. So it is clear. It is clear that over time inflation rises, and what happens with the real estate market is boom. Prices go to the moon. To the moon, y'all. So check it out. It's not just happening here in the U.S. The inflation issue is happening around the world. So inflation woes plague developed nations, according to Statista, right? Monthly reading of the Harmonized Consumer Price Index for U.S. and European countries. What do you see happening? Okay. It'd been really easy for Dr. E to just throw up a bunch of words and be like, hey, inflation is happening and it's going up and it's going up all over the place, right? But I wanted to show you these graphs from these various entities to show you a story that is happening not just in the U.S., but globally. All right, inflation is running amok. The U.S. is leading the charge on that, but everywhere else it's happening nonetheless. 2021. And my question to you is, what do you think is going to happen next? Okay, especially looking at this bad boy. So the World Economic Forum actually put this out, not me, and they ran a graph or some data from 2010, that's January of 2010, to December of 2021, really recent, and we're talking about inflation being over 5%, right? Greater than 5%. Check that out. To the moon, y'all. And whether it's advanced economies, AE, that's us, emerging markets and developed countries, EMDE, everybody going up, y'all. It's going up. What do you think is going to happen next? I don't know, but this does not look good. All right, inflation is running amok. It's running amok. It's out of control. And this is the reality. I encourage you to do some more research on this. Look at the World Economic Forum sites. Look at Statista, and others. To find out if this is true or not. But you can clearly see it when you go to the gas pump. You can clearly see it when you go to the grocery store. And I want to link this to notes. So I want to tell you a couple little stories. I'm going to make them relatively quick. And if you like, you can rewind and check this out. But this is what happens with notes during the same time. So these are a couple of real numbers from my good friends at Nap Nation and other locations that have let me kind of use their numbers to illustrate this. But we're looking at this example here, and I'll just run you through a little narrative. The very first one is a performing note. It's an LSO, which stands for lease option. Lease option. It's basically an REO that you buy. You purchase it right out. And the unpaid principal balance was $22,000. $482.64. The purchasing price was $15,000. Obviously, it is a LSO, right? It's a this one was a performing note, actually turned into a performing note. So they got a really good deal on this one. And this one was the return on interest. The return on the investment was 13%. It took about 2 to 6 months to get the money out of this. And what happens is it's on a 2-year lease option. So what's neat about that is when in inflationary times, shorter time frames and shorter contracts can work in your favor. You still have the payments coming to you, but the shorter time frame, instead of a 30-year, it's a 2-year. You're in and out of that thing in less than 5 years, and then there's a balloon payment on top of that. All right, a non-performing note situation here. Clearly, look at those numbers. Unpaid principal balance at $22,000 and change, and then the purchase price relatively low, can return a 54% investment on your money there in about 3 to 12 months if it's a payoff situation. So you can actually look at these by looking at the pay history and or doing a really great deep dive, doing a skip tracing, okay? And it's a process where we are really looking at the individual and their capacity to pay back. Now, sometimes this happens by pure accident in terms of a payoff, but you can almost, especially with a non-performer, but you can almost predict these things by looking at the numbers and looking at the pay history to see if a payoff is an option for you. And if you get it at the right price, cha-ching, you cash out that register like nobody's business. All right, non-performing note here. You can see the numbers, bang, bang, 9% return in 6 to 12 months. What if you get it to be a reperformer? What's neat about being a reperformer is once it gains some good note karma, as one of my mentors likes to say, after a year of curing it, of whether it's a cure or whether it's just rehabbing it and making sure it looks really nice, we can sell it. We can move it on, right? After 12 months of payments, you can actually sell it, and it's a performer. It's a performing note, so you can get performing note prices, and you can get all your money back, plus some change while you have made your 9%. An non-performer CFD here, interesting. I didn't get the price on that, but the unpaid principal balance was $30,000 and change, and then the return on investment was 21%. It took 12 to 18 months, and it became a reperformer, and they sold that reperformer again as a CFD. And a CFD is a contract for deed. It's a land contract. Those contracts are a little bit more flexible for you, and you don't have to go through the whole foreclosure process at some points in time with those, so they can be really, really, really attractive. So you can see that based on the little examples that I showed you, we understand that inflation really exists. It's a real thing. It eats away and corrodes away your purchasing power. And so your strategies for notes can just shift. I'll say that again because I know you missed it. Your strategies for notes can simply shift. They can pivot slightly, okay? And how you approach them, how you engage them, how you get access to them, not get access to them, but rather how you access them and think about your exit strategies can shift. And that in these kind of ways that would help if there are inflationary times. The first would be lease options. Lease options are really nice because they're short contracts. You have flexibility in changing the percentage on those once the contracts are up and converting it to a CFD. Also, you can get really neat payouts on lease options. You get to own them, and you get to have lots of control over that property and that paper. You can sell partials. Selling partials is really neat. If you have a performing note, you can kind of sell off the payments to someone, which is a really neat opportunity for you. Big businesses call them leverage buyouts. You can sell the performing notes once they are performing. So maybe you cure the note and it becomes a performing note. After about 12 months, they start to look really attractive to people because they want cash flow, and you can just sell that for a premium, which is nice. You can flip the note, so as soon as you get it, you can just sell it right away, and then you make the difference, and that's called arbitrage. Really neat. You can wholesale the notes too, which is you can be the broker in between the deals between the buyer and the seller, right? And you can play the middle ground. So that's all I've got for you today. These things are really neat. Options in notes are plentiful and bountiful despite inflationary times. If you really like this stuff, contact me. I'm easy to get at, jason.eestates@eestates.net. You can subscribe. You can hit that notification bell. You can hit that like button. And you guys take it easy. One family.